Good morning. This is Andy Weissman. I appreciate your all being with us. We have a couple of hundred people listening in this morning, so I'm just going to jump in the presentation. I'll skip over this, except I assume you all enjoy the opportunity to look at a picture of me when I was much younger. But one of the things I wanted to highlight at the beginning of the presentation is that this week is an exciting week for us because we're launching a new product. It's the first time we've had a daily product. It's called the Energyplast Report, and we think it's potentially especially valuable. Part of our philosophy is that we feel it's important to integrate as fully as possible market analysis and weather. This does this, and in one two-page report combines what we think is some of the most reliable weather forecasting information available and our market analysis. To the best of my knowledge, actually, there's nothing in the market available in the market that quite does this. It has weather forecast information for the current storage week, the next storage week, and the following week. I don't think there's anything else that extends out to the third as far as this does, and then it translates all that into degree days, anomalies, and impact on demand, and while it's cut off at the bottom, impact on prices as well. You'll each be having an opportunity to sign up for a free trial of this, and we hope you will. We think that you'll find it especially valuable, and particularly as the space heating season is starting to ramp up, when we think being able to see what the weather is likely to look like a couple weeks down the road and the impact on demand will be pretty critical in trying to get a heads up as to where prices are likely to head. In terms of the agenda today, we're going to talk briefly about our approach to market analysis and lessons learned from recent market experience. One of the major themes of today's presentation is that we think we're at least quite possibly going to see a pretty significant shift in the natural gas market in particular, and really both natural gas and electricity, where we've seen prices in trade in a very narrow range for a long time. We think, depending on the weather, there's a pretty good chance that's going to change quickly, and that we're going to see more price volatility. And as we look further down the road, we think it's almost that we're going to shift to a new market paradigm, where by the time we get 2-3 years from now, we may see levels of price volatility that we've rarely seen in the past. So we're going to talk about that a little bit. A lot of the presentation is going to be focused on our price forecasts, including Dr. David Gold from WDT is going to present WDT's most recent weather forecast. And then another theme that's going to run throughout the program is that in terms of our basic methodology, what we focus on a lot is trying to give you the best advice possible as to when to pull the trigger on buy or sell decisions. And we do that both in our market analysis and in the WDT weather forecasts, which we think our particular strong suit is our 8 to 15 day and 16 to 30 day forecast. The 16 to 30 day forecast, in effect, gives you a heads up as to what the 10 to 15 day forecast might look like 5 days from now. And we think that's really critical in determining where the market is likely to head. In terms of our approach to market analysis, really the only point I want to emphasize is towards the bottom, where we mentioned briefly about scenario analysis and timing of decisions and fully integrated analysis. we're very much a believer that the natural gas market and electricity markets are dynamic. And what I mean by that, we participated in, I spoke at a couple different conferences in Houston last week, and some of our peers, really many of the other people who do analysis of the natural gas markets presented their analysis of likely supply next year and likely demand. And we do that too, and we're going to present that today. But from our standpoint, that's just a starting point because there are other forces at work, particularly weather, and more recently also producer decisions about drilling and completion levels that have a major impact on what actually happens with prices. And so we think what's critical for our being able to add value for your decision making is to focus on those more dynamic qualities. Because as most of you know, and if you look at the NYMEX forward curve as a predictor of natural gas prices, historically, occasionally it's been right, but usually prices turn out to be way different. And that's partly because of historically maybe some flaws in some of the analysis was done, but it's largely because of the impact of weather and technical factors and market sentiment. And so we think that's where those are the issues that we think are most important to focus on. In terms of disruptive forces on the horizon, I'm going to talk more about that later. But just to kind of highlight the theme at this point, if you look at the graph on the bottom left, for example, it tells a story that you're all familiar with. Really 2 points. First of all, the clear downward trend, and the fact that both with cash prices at Henry Hub, which are the black line, and with prices in the Northeast, in the Marcellus Shale and Utica, we've seen a consistent downward trend, and prices are currently at multi-year lows. And the other thing that stands out, particularly if you mentally look at January 15th at the bottom and look at what's happened with Henry Hub since that point. It's traded for quite a long time in really extremely narrow range. And we think in terms of disruptive forces that we're kind of on the cusp, depending on whether it could be very soon or it could still be a ways off, but we're on a cusp of a period where the market's going to really shift very significantly. We're going to see a lot more volatility, and I will talk about why more later. And if you look at the right, for lots of reasons, but clearly in part because of natural gas prices, you see a similar trend with, we just picked as one example, Cal 16 electricity futures for the New York, PJM, and ERCOT. And they also have, particularly over the last few months as natural gas prices have declined, and after the experience of very few price spikes this summer, they've also been trending down and are in multi-year lows. And again, we think that will change also in the future. Now, I just thought I'd paint a picture at the outset. All of you are familiar with what's shown on this slide, that we've had spectacular growth in U.S. production. If you look at the graph on the left, it still boggles my mind that shale production is now over 40 BCF a day. I don't think much of anyone would have predicted that, when the so-called shale revolution began. And if you look at the right, that shows what nets out the declines in conventional production and offshore production, and the reduction in Canadian imports. And what you see, well, let me put it this way: the total height of the bars, including both the blue and the gray, gives you the net increase in production, basically. And as you'll see over this time period, look at 2015, the net increase, even after you net out the declines in conventional production and offshore, has been 20 BCF a day. And then we tried to separate out, the changes, really mainly adjust for the reduction in Canadian imports, and to come up with a number of what does that mean in terms of the net increase in the supplies available to the U.S. market, and that's what's shown in blue. And as you'll see, even after you've done all those nettings over the last 7 years, the supplies available to the U.S. market have increased by more than 15 BCF a day, and that's stunning. That's from a starting point of roughly 50 BCF a day, a 30% increase. And in terms of setting the context for everything else we're talking about, essentially demand has just not grown, up until now at least, has not grown nearly as rapidly. And therefore the key factor in looking at where we're at now and where we're likely to be next year and the years thereafter is that for quite a while now we've been in a chronically oversupplied market. And for the last 12 months in particular, we like to look at almost all our analysis is done basically on the storage cycle, starting from mid-November of last year until I guess we're only about 5 weeks away till the end of the injection season. And during that period, what our analysis indicates is that the U.S. market in a normal weather scenario would have been oversupplied by 4.3 BCF a day. Huge. That works out to, I'm trying to do the numbers quickly in my head, it works out to almost 1.5 trillion cubic feet a year of excess gas. And not surprisingly, having all that excess gas compared to market needs had a major downward impact on prices. Now, in terms of that's a starting point. What are the other key factors that affect prices? Weather, in pretty much every presentation I make, I emphasize, because I think it's just absolutely critical, the impact of weather on the supply-demand balance. Because again, that's why I think it's important to do kind of a normal weather analysis of likely prices to give you a reference point. But I always want to emphasize that that's just the starting point, because especially in recent years, it's been relatively atypical for weather for the year as a whole to be close to normal. It's happened, but more typically we've had some very significant swings in weather compared to normal demand. And graph on the left, the period that from a market analysis standpoint, almost in a sense, the single most important factor that affects prices is the winter weather, because the potential swings in winter weather are so extreme, and the impact is not just for the winter, but it usually has a major impact all during that 12-month storage cycle until the end of the following injection season. And what a graph on the left shows is what's actually happened over the last 4 winters in terms of space heating demand. And if you look at it, if you start at the bottom, 4 winters ago, we had an extremely mild winter, and it got a whole lot colder. Then we had what I still like to call the polar vortex winter, although David and his colleague Ed Berry will correct me and say from a meteorologist standpoint that's not quite right, but I think that's how the label we all use. And we all remember that was extremely cold. And then again this winter, we had fairly cold. And if you compare the mildest winter to the coldest, the difference in demand was 1.5 TCF a day. And so the weather alone is equivalent, could either cancel out or exacerbate the entire supply excess. It's comparable to the entire supply excess we had this year. And it's also, if you look at the graph to the right, it's not just the winter weather, the summer weather has a big impact as well. Many of you may recall that there were National Weather Service forecasts and others predicted quite a mild July and August, and maybe a near normal September. And that's not what happened, notwithstanding the El Nino conditions. If you look at the ranking of the summer months this year, June was extremely hot. I think a lot of people anticipated that, but it was pretty close to, was the 4th hottest of the last 21 summers. July and August, which many people thought might be mild, were actually very close to the norm during the last 21 years, and September was really off the charts and was the hottest September ever. And those, that difference between the expected weather and the actual weather, also a huge factor. We're all familiar with the supply story, that the rig count has been declining very rapidly, and supply just hangs in there. We'll talk a lot more about this later. And so, what does that all boil down to? And one of the things we want to, that's central to the way we look at the market is essentially, the way we look at it, we start with the normal weather supply-demand balance. We adjust it for differences in weather and differences in production, and that gets us to the amount of the surplus supply. Doesn't have to always be a surplus. Back a decade ago, we were really having deficits, which is why prices went up as high as $13. But in recent years, we've been in a normal weather scenario, and really in every year except the year of the polar vortex, in the end, we had significant excess supply compared to what would have been needed, the amount of gas that would have been used if prices had been closer to the $4 range that until recently a lot of people were still expecting might be the long-term norm. And when you're in that situation where you have a surplus left over, the market's got to balance some way. And the way it balances is, has been balancing every year, is for cash prices to drop low enough so that it becomes, compared to a $4 scenario, it becomes economic in more and more instances to shut off coal units, or at least ratchet down their utilization and ramp up gas units instead. That's the fun. We use the term coal displacement as a shorthand, but that's the fundamental way that the market balances. Right now, with prices at Henry Hub yesterday were at $2.46, and they were close to $1 in the Northeast, and with the 246 in particular, essentially, to oversimplify just a tiny bit, the reason why the prices at Henry Hub were at 246 was that in order to balance the market, the cash price had to drop low enough so that there was a high level of coal displacement, so that there, in other words, so that there were many situations around the country in which it no longer made sense economically to use existing coal units, and so they were ratcheted down, and natural gas generation was utilized instead. That in our mind, that's the dynamic that drives. I should phrase it differently. We believe it's pretty clear that in terms of the dynamic that drives prices, that's why prices are where they are. So that's been very important. And this year, because we had a big excess supply, we needed lots of coal displacement. I'll get into the other factors that were involved in just a second. But what we've seen on average during the year is about 3 BCF a day of coal displacement relative to the relative utilization, what the utilization of coal and gas units would have been if natural gas prices had been closer to $4. So that's a key dynamic, and we're going to talk about it more. The reason I wanted to raise it now is that that's a change. And what's been happening already and will happen increasingly is that as more coal plants are retired, it becomes necessary to operate more gas plants irrespective of price. And as a result of that, the availability of coal displacement is shrinking. Now, if you look back to 2012, when prices were pretty similar to what they've been the last several months, the prices got down to $2, but the average price for the first 9 months of 2012 was $2.75, which it turns out is very close to what the average price has been this year, and it's actually almost identical to what the 12-month strip was yesterday. And the point here with the graph on the right is that at that price level, we had on average during the year 7 BCF a day of coal displacement, and because of the retirements and increased utilization of gas, retirements of coal and increased utilization of gas that's occurred, we're now down to a much lower level, and that's going to continue to shrink. And that's really important because that's the ability to switch back and forth between coal and natural gas is what's used to balance the market, and that's clearly shrinking. Now, if we look, kind of essentially started at a high level, and now I'm going to successively drill down. And after David presents the weather forecasts, get into our specific price forecast. But just drilling down further, this year, as I've already mentioned, the market has been still been oversupplied by a very large amount, 4.3 BCF a day. And what's happened, if you look at the graph on the left, the way the market is balanced and gotten to the prices we have now are really 3 factors. By far the most important has been the reduction in price in order to induce more coal displacement, and that's used up about a TCF more gas than would have occurred if prices were higher. Second factor that has been significant this year has been that we've had, let's say roughly 200 BCF of above normal weather-driven demand, and that's been important. Because if we didn't have that, prices would have had to been even lower to induce more coal displacement. And then the third thing that's happened is that we started the most recent storage cycle with what was at least arguably a storage deficit where at the start of the withdrawal season last year, storage was at 3615, if I believe was the number, which we just surpassed. The storage is now at 3633 BCF, which is slightly above where we ended the injection season last year. And that helped too, because essentially the fact that we're going to, storage this year is going to wind up somewhere roughly around 3,900, we believe, depending in significant part on the weather over the next few weeks. And essentially that the 250 BCF or almost 300 BCF addition that's being made to storage, in effect, it was functionally equivalent to demand. It also, helped to absorb some of that excess supply. So, we mentioned that because those are the dynamics that drove the market this year, and the same factors are going to drive the market next year. One of the things we want to emphasize, we've kind of had the illusion, there actually some people say kind of that the market, that we've had the illusion that kind of prices, roughly around 270 for much of the year. We're sort of, that's going to be the price of natural gas. And, it wasn't surprising that we've gotten a little bit of a dip as we get into the middle of the shoulder season, and demand is very low. But basically thought a lot of people, have started to believe that's kind of inevitably where natural gas prices are going to be under most conditions. And when the graph on the right is telling you that's not the case at all, and that actually prices could have been much lower from a producer standpoint, that very depressing thought could have been much lower, that if we'd had normal weather and that, above normal weather demand on the left hadn't been there, instead we had normal weather, prices would have, for the last 11 months, would have averaged 35 cents lower. If the summer had been as mild as the National Weather Service predicted it would be, that would have driven prices down another 10 cents. And, if we had just been refilling storage to exactly where it was at last November, that would have lowered prices by another 30 cents. So we could have easily seen prices that were closer to $2. And we want you to be aware of that as we talk about what's going to happen next. Then I want to just kind of summarize. I've talked about why we think there may be a lot more price volatility. And what I want to emphasize is there is really there are a lot of reasons prices have been stable. There are a lot of major things that are going to change going forward. And these will partly affect the next 12 months, and then they could lead to even more price volatility over time. One of the factors in terms of the next 12 months clearly is that there's, depending again on the weather over the next few weeks, it's quite possible that we'll set a new all-time record for end of injection season storage. Secondly, there's still a lot of uncertainty regarding fall weather. Thirdly, there's some forecasts that are calling for a blowtorch hot, or just better, blowtorch warm December, extremely mild temperatures. If that happens, lots of further downward pressure on prices. There will be further increases in supplies from Marcellus and Utica, and the question is how much. And so, get all those factors that could have really major impacts. And then, as we'll see further, there will be a significant tightening of the supply-demand balance next year, or at least the weather-neutral supply-demand balance. It's going to change a lot. Another factor that I think could turn out to be extremely important. We saw last week that the U.S. rig count went down by 29 rigs in 1 week. I think depending on what happens to oil prices, that could be an early sign of the potential producers are in a extremely tight, for some dire position from a cash standpoint. If that could lead to drastic cuts in drilling. Cuts last week, it was 26 oil rigs and 3 gas rigs that were laid down. But the important point for present purposes is that a lot of those oil rigs are in hybrid plays that produce both oil and associated gas. So if we do see drastic rig counts, that could have a major impact on gas supply in the next 12 months. And all other factors being equal tend to drive prices up. I mentioned earlier the decline every year in the availability of coal displacement, and what that means in terms of reducing the safety, shrinking the safety valve that has tended to moderate swings in prices in natural gas for the last several years. And then finally, the question of what's going to actually happen with LNG exports. The first export facility, Sabine Pass Unit 1, is just started the commissioning process, just starting to take in gas, I think within the last week. It will take a while before it becomes fully operational, but there's the potential by the middle of the year that 2 units will be operating at Sabine Pass and potentially using, if they go absolute full capacity, it starts to get up to 1.5, 1.6 BCF a day of utilization. For reasons I won't go into here, the numbers you see are usually too low, and the rated capacity for each unit is actually 0.7 BCF a day, and there's another almost 1/10 of a BCF a day required to run the facilities. So they could be using lots of gas, or they might not. They might have delays in startup, or potentially of more concern. Spot market prices for LNG are at extremely low levels, so there's an open question as to whether all the cargoes will be taken. And so the point is that I really want to emphasize, and it relates to the title of the program, is that we've been in this kind of a market that has been severely oversupplied, but nonetheless, partly just because of the way it worked out with the factors I mentioned previously, we've had prices for natural gas in a very narrow range. And I think we're going to see, we're moving into fundamentally different conditions where the supply-demand balance is starting to tighten, and that in and of itself, we're still going to be oversupplied, but that in and of itself creates more potential for price volatility. And we also have all these other long list of factors that, let's see, our slide changed on its own just a second ago, I apologize. All these other factors that could lead to lots more price volatility. And so what that boils down to, and I'm going to turn it over to David in just a second, is that we think the market's at a key juncture where prices could break sharply in either direction. We think it's going to take, it's critical in that circumstance to do the kind of analysis that we present in our reports, where we're focusing on not just on kind of the base case supply-demand balance, but all the factors that can swing it. And call your attention briefly to the graph at the bottom left here. If you look at the first pair of bars, the blue and the gray, it shows you the gap between supply and demand this year. The gap this year between supply and demand, to phrase it more clearly. And if you look at the pair and bars on the right, you'll see the supply actually may be shrinking in part because of reduction in Canadian imports, and demand may actually be increasing, and so the gap between supply and demand is definitely going to tighten, but the blue bar is still higher than the gray. In a normal weather scenario, we'll still have a supply excess. And I think I've got, we are going to drill down into what that means as to prices. All I want to emphasize here is that we'll discuss prices will be highly dependent on the factors that we're already started to flag, and we'll talk through what the potential outcomes are and what we think are most likely. What I want to emphasize for here is under the second bullet where it says key market drivers. The two most important things by far, we think, in terms of where prices will wind up in the range that's indicated below, are weather. That's why I wanted to emphasize just how significant the range of weather outcomes can be. And then secondly, producer decisions regarding CapEx. When we look at production, there are a number of firms that are doing a real good job now of saying that sort of like under a business as usual condition, here's on the assumption that the rig count, it basically says stays close to where it is now. This is what production will be, and again, that's a good starting point. But we think one of the things to be keenly aware of over the next 12 months is that given the financial pressures on producers, there are two things that are possible. One, if we do see a boost in natural gas prices, and particularly if we see prices rebound in Marcellus Shale and Utica, we could, not instantly, but over a period of a few months, see a pretty significant supply response. If prices in Marcellus Shale are near $1 today, they've averaged about $1.50. If they got back to $2.25, for example, we might see a 2 BCF a day increase in supply over a period relatively quickly, some of it almost immediately, some of it over a period of perhaps 3-4 months. And so, that's, I think something that's likely to occur if prices go up, and if prices for natural gas go up. On the other side of the equation, if prices for oil stay low, we do think there's the possibility of kind of scorched earth, drastic rig reductions, not by everybody by any means. A lot of the larger producers or the producers who are hedged, may just keep on going, but there are substantial size independent producers who are saying that if oil prices go back to around $40, they may just stop drilling for a while. And there's actually one company, Stone Energy, that publicly announced it was taking a timeout and was actually shutting in some of its wells and not going to do any more drilling. That's the extreme, but there is a lot of potential range associated with that. And there also, we'll talk later, another major change that's occurring is that we're seeing the early stages of a change in pipeline flows as the constraints in the Northeast start. They're just at an early stage of starting to be relieved, but that's an important factor too. And at this point, having set the context that way, let me turn it over to David, and then we'll go, he'll turn it back to me in 5 or 7 minutes, and I'll start going into the price forecast.
Thank you, Andy. Good morning. This is David Gold. I am a scientist and a forecaster here, working side by side with Ed Berry. Here's a little bit about us. Don't want to spend much time going over our credentials. All I'd like to say at this point is that I'd like to acknowledge that we do work for Weather Decision Technologies. They are an industry leader in weather analytics. For many years they were a leader in short-term forecasting only, developing novel approaches in radar technology in delivering that to millions of users through apps. And not too long ago made the decision to get into the long-range forecast space, the commodity and the asset protection space, and hired myself and Ed. Ed has a very long career as a sub-seasonal forecaster. He's one of the most experienced at this. He's been doing this many years. He and a former collaborator, Dr. Klaus Weissman, did a lot of work in developing a framework to assist with the very difficult problem of making long-range, extended forecasts. And I don't want to spend much time on that because I don't have much time, and I know that most people really just want to get right to the prediction. So I'm gonna do that. I'll only say that the framework that we use is the one that Ed and Klaus developed and have put into practice over many years. There are no silver bullets. Everybody attending this webinar understands the grave difficulties that face the weather forecasts and the traders that have to make decisions around that. And we try to address that. This is an inherently probabilistic endeavor. One has to address the uncertainty when making these kind of predictions, and we try to do that in a number of ways. I'm only going to present kind of one methodology that we've adopted lately. This is definitely a work in progress. Our latest subseasonal forecast extends into a time of the year where predictability is perhaps at its lowest. And that's in large part due to the fact that the global circulation, including the jet stream systems, are undergoing seasonal transition. Now this year, I think most, or if not all, meteorologists that are in the business of making forecasts are hoping very much to leverage a very strong El Nino. At least that's certainly what it looks like by most metrics, a pretty robust El Nino, and hoping to use that to make, what one might hope would be higher confidence forecasts. However, there are some problems. Number one, this El Nino, like the others that we've had historically, is very different. Like snowflakes, no two events are alike. There are other issues related to climate trend that are confounding the ability to just simply leverage the El Nino signal. So that said, we do, however, see evidence right now that there has been recently an increase in the tropical, extratropical interactions that would be supportive of an El Nino type outcome. Specifically, we do see some evidence that the tropics are beginning to get involved in impacting the mid-latitude jet stream in a way that would lead ultimately to a series of low-pressure systems developing, amplifying over the western United States and closing off across the southwest, southern Rockies, and into Texas. The few El Ninos that we do have in the historical record, I would note that in fall, there is a signal, there is an increased risk for very cold and wet weather to develop in the very regions that we've highlighted in our 16 to 30 day outlook as having risk for anomalous cold. And so there is some support of the historical record, although as I just stated, we have to use that information with some care due to how different this El Nino is from the others, and given the impacts that we think are ultimately related to climate trend. Now, I also stated that these forecasts are an inherently uncertain endeavor. One way we try to address that is simply by presenting an alternate case. What's another possible pathway that the atmosphere can take from conditions that we're diagnosing right now? And that's basically warm. And we've seen that on average from midsummer all the way forward, we've had a very widespread warm outcome. And if the jet stream does not buckle and amplify these low pressure systems over the southwest, or we get only weak low pressure systems like the one that's spinning around the southwest right now with virtually zero connection to any cold air source, then the map shown at lower right is the more likely outcome. But we're putting more weight on the primary scenario, the one in the lower left, for the subseasonal time frame. That would be roughly late October to early November. Leveraging the same subseasonal signals, the same information, we're carrying that forward into November. and presenting the deterministic map shown on the upper left. Again, I emphasize that a probabilistic approach is required, again, addressing that in-house, not only via these alternative scenarios, but also we do present distributions. We give risk maps, for example, for each of our scenarios to try to give a sense of how likely extreme temperatures are under each scenario. There's no perfect way of doing this. This is just something we've settled on. Now, November, upper left, again, same basic idea as in our subseasonal. A series of events where the Pacific jet stream, which should undergo and is now undergoing seasonal strengthening and also shifting southward with not only the seasonal cycle, but in concordance with what you would expect with an El Nino, that should break down at times, leading to these closed low pressure systems and tapping some cold air, driving it into the south. Now, by winter, of course, what should happen, and I say that with big quotation marks, is the jet stream should extend fully across the oceanic basins, including the Pacific, to the west coast of the U.S., split, leading to a warm north, cold south scenario. That's the classic El Nino outcome. Of course, we're looking out, about 2 months from now. Even with the El Nino signal, because of what I said earlier about this event being so different, we have to be careful. You can see some broad similarities in the climate model forecast below, but again, you have to take those with a grain of salt. I will say they have not done a very good job in recent years in capturing, for example, big flips to cold weather, like in the past 2 winters when it did turn cold. They were often lagging behind, and a big part of that is because they are strongly influenced by trend. So let's recap. Most likely November outcome, in our opinion, is for cold anomalies to develop, perhaps localized to parts of the southwestern and south central U.S. At this point, the most likely December outcome will go with the El Nino composite, but with very great statement of caution. We don't have a lot of confidence that will verify, and there is a risk, a non-negligible risk of a very different outcome, which we'll cover in a minute. The rationale is simple. We're hoping that we get some, meaningful El Nino influence on the winter pattern. I will say that El Nino, the sea surface temperature response to El Nino typically peaks early in winter. The jet stream can often respond very strongly only later in winter. We're sort of anticipating something like that, where the jet stream just kind of strengthens, comes across the Pacific, splits across the U.S., but that's if we do get that atmospheric response to El Nino. As I said, there are other complicating factors. The climate model probabilities loosely reflect the same idea. Now, what could go wrong? Well, for November, what could go wrong is the recently observed behaviors continue. Basically, the polar jet stream continues to come straight out, but stay very far to the north of climatology. It does not buckle into these troughs across the western and central states, and we just persist a warm outcome. What could go wrong in December is that, again, we've seen these years recently. Actually, the last 15 years, we've been tilted toward La Nina. And even though we've got, fairly robust El Nino conditions throughout the global tropics, and in some cases, we can certainly detect that in the atmosphere, we've also seen other behaviors that are counter to that. And that's, in fact, one of the reasons that we had such a warm summer. So a risk for December and for the balance of winter would be if, instead of coming straight across the Pacific and splitting across the U.S., if the jet stream just began to collapse. So basically, if El Nino itself collapses, or we see atmospheric behaviors that presage that, the jet stream itself could also do so, and that would generally suggest a much colder outcome. The only way we're going to know which way that tips is by monitoring during the season very carefully, daily monitoring, and that's something that is a core part of the framework that we use to try to catch the signs that a very different outcome will occur. That's all I've got. I'll turn it back to Andy.
Great. Thank you, David. What I'm going to do now is that I'm basically going to spend the rest of the presentation talking about how we use our market analysis and our assessment of kind of the weather-neutral supply-demand balance to assess what is likely to happen with prices for natural gas, how that will ripple through to electricity prices, and how the same demand, the weather forecast will further affect the frequency of scarcity pricing in the electricity market. And what I want to emphasize more than anything is one of the last points that David made, which is the importance of daily monitoring. And what I want to say is this: it would be nice if we lived in a world in which weather was completely stable, or at least weather forecasters could make forecasts with a very high level of confidence. Occasionally, that actually happens. But more typically, in the real world, it's a different situation. And it's actually not even that there are necessarily mistakes made by weather forecasters. What it is fundamentally, and this is part of what I've learned, we've been working closely with Ed and David for almost more than a year and a half now. This is part of what I've learned from them. That typically, very often, there are competing forces in the atmosphere. And right now, one of the forces is El Nino. And then there have been some major changes in the ocean temperatures and in the jet stream that create a situation that the core conditions in the oceans and the jet stream right now are very different than they were at the time of the last strong El Nino. And they are, in effect, pushing up against the El Nino conditions, which are warm temperatures in the mid-tropics, are pushing in one direction, and these other forces that have developed over the last 17 years since the last strong El Nino are actually pushing opposite them. And so the reality is that there's no way for anyone to know with perfect certainty exactly what's going to happen. And instead, quite to the contrary, anyone who's looking just at one weather forecast with rather than multiple scenarios is taking a big chance, because the chances that forecast will go wrong are pretty high. And as each of us has painfully learned over the last many years, that can lead to big losses or big lost opportunities. And so what we think is very important is to identify those competing forces, have an understanding of what the odds are of the weather going in either of the two possible directions, because those two directions usually will be quite different from one another in terms of the outcome. And then to emphasize the point that David made towards the end, just monitor and monitor and monitor and monitor, and look for signs of the way in which the weather is actually going to break. And so that's what we do collaboratively with David and Ed. We use our market analysis and work with them every day to try to look for situations in which circumstances are developing such that we think prices are likely to move in one direction rather than another. And those forces aren't just weather. Technical factors are extremely important. Market sentiment matters. Lots of different things matter. The weather is certainly the single most important. And so how do we use the weather to make decisions? Just a second so we can get to the point. What I'm going to do, sorry, I probably ought to start back here. I'm going to divide the rest of the presentation into 4 time periods. What's going to happen might happen with prices immediately. These are at the very bottom of this slide. Immediately, this winter, injection season, longer term. Near term. Well, we've actually been able to, this is today's a excerpt It's actually the part of the first page of today's flash report. And we've actually been able to use the daily flash report very successfully to predict short-term price movements. We're not going to be right 100% of the time. No one will, but it's actually working quite well. And let me explain how we used it. If you look, as I explained at the outset, the three weather maps are left to right: the current storage week, the next storage week, and the following storage week. And you got all the data regarding degree days and temperature anomalies and impacts on weather-sensitive demand, which is power sector plus space heating, are all displayed on this slide. The way we've used this is we basically made three predictions that have turned out to be right. One, if you look at the map in the middle, you see a period of very warm weather. That warm weather is now reflected primarily in the 5 to 10 day forecast. And we used that about 10 days ago. That was just starting to show up in the 16 to 30 day forecast. And then on the map to the, what would have been 7 days ago, the map to the right, on the right-hand side. And so we were able to use that 10 days ago to say there's some very warm weather coming, and we think as the market sees that, as that starts to show up in the 11 to 15 day forecast, prices are going to go down even further, and they did reach the low for the year. And again, that wasn't the only factor, but I'm just trying to illustrate the role that weather plays. And then, more recently, this week, for example, if you look at the map on the right, we were seeing every day a greater likelihood that we'd start to get some colder weather. Also, as we go into fall, the norms get for heating degree days go up quite substantially every week. And so as we began to focus on the panel to the right, what we were seeing is a pretty significant uptick in demand. And so we were able to use that successfully this week. For example, yesterday's flash report, we said as this starting to, given there's kind of a bottom had formed pretty clearly at 243 in anticipation of fall arriving, that yesterday we were saying there's starting to be more signs of fall arriving. Prices are likely to go up in the morning, and then as very often occurs, they'll probably sell off with profit taking at the end of the day, because people don't want to take the risk of how the storage report will turn out. And then we said this morning, in the flash report this morning, other forecasters shifted their forecasts for the 11 to 15 day period somewhat colder. We basically, gave our subscribers a heads up that was occurring, what's likely to occur, really starting towards the end of last week. We adjusted our forecast up even more with it's almost a 10 gas-weighted heating degree increase in demand, and I can't remember now whether it's 12 or 14 BCF increase I meant to say 10 HDDs and either 12 or 14 BCF. And so, basically, notwithstanding, we continue to look at alternative scenarios, but basically looking at them, we said we think the odds are going up significantly that we're going to see this colder shift. And so we said this morning, when early in the morning, when prices hadn't moved yet, we thought there was going to be a gain today, and we think there'll be further gains over the course of the next several trading days. And so, that's a starting point of how we use the analysis that's reflected in the flash reports. Stepping back a little bit more, here is on the left is WDT's 8 to 15-day forecast for today, and then on the right is their most recent 16 to 30-day forecast that was issued yesterday afternoon. And as you'll see, what we're seeing as we read Ed and Dave's analysis of the weather conditions and translate it into HDDs and BCF of demand, what we're seeing is they are becoming increasingly confident. It's still, let me phrase it slightly different. They're clearly their expectation that we're going to see this colder shift shown in the 16 to 30-day forecast is increasing. And we turn that into degree days and demand, and that says to us, we think the odds are increasing that we could see if we see a 5 to 10 cent move this week, that we could see an additional 10 to 15 cents above that, so that we could see, we think there's a significant chance now that we're going to see a 15 to 20 cent move from where we were at 8 o'clock this morning. So we're advising our subscribers that that's what we think is going to happen near term, that if 15 to 20 cents would be somewhat more than the temperature anomalies alone might justify, but what the market, as I think almost all of you are aware, what the market tends to do as we're just before winter is that it takes whatever is happening near term as a sign of things to come. And so that might make the increase in prices a little bit more rather than a little bit less. And so that's, in terms of what we think is going to happen over the next 2 to 3 weeks, that's what we think is the most likely scenario. We, at the same time, we recognize that, as David explained, that's the most likely scenario. It's not by any means a certainty. And so what does that mean? How do we use that information? How do we use the alternative scenario that WDT, at my request, included in their 16 to 30-day forecast yesterday afternoon? And the way we use it is to go back to the point that David made. We monitor and monitor and monitor and monitor. And by we, I mean both WDT and EBW. What David and Ed are doing is that they are doing a really in-depth weather analysis every day, in order to see how kind of the basic weather drivers are changing and how that affects the odds of one outcome versus another. And when I say really in-depth, that's in part, they look at the same weather models as everyone else. That's certainly part of what they do. But what they also do, that those of you who attended our live program in Houston 2 weeks ago, or have heard prior webcasts are familiar with, is they look at more fundamental drivers, including longer-term, slower-acting processes that are occurring in terms of the development of an enormous warm water pool in the far West Pacific and changes in the jet stream. And they're looking at those every single day in order to determine, in part, what's really likely to happen with the weather, and identify whether the model predictions are likely to be correct or instead more likely to be wrong. And they prepare a commentary every day that specifically addresses whether they think the models are generally in the right direction, or whether it's more likely that they're going to turn out to be wrong. And so, for a trader, we have recommended putting on long positions now. It's not overwhelming. It's not time for a huge bet, but we think the odds were pretty favorable. For someone who's looking at hedging, we think, it'll be important to monitor this run-up, and that it might be appropriate to do some hedging depending on how far the run-up goes and what the 16 to 30-day forecast looks 3 to 4 weeks from now. That will tell us a lot about where prices might be in late November or December. And so those are the kinds of factors that we look at. In terms of the winter forecast, I spent time at the beginning talking about the supply-demand balance because I think it's absolutely critical to start with a understanding of whether the market is undersupplied or oversupplied, and if so, by how much. A lot of people do their analysis primarily by doing a year-over-year comparison to supply and demand and storage. We think that's helpful, but we think you need to go a step further and really understand whether the market is oversupplied or undersupplied, and if so, by how much. And what this slide is showing you, the slide on the left shows you all the factors that we think are going to affect, in our base case, will affect supplies this year. And on the right, all the factors that in our base case will affect demand. And those factors, if you add them all up, lead to the conclusion that the market will, in our base case, kind of the business as usual normal weather, the market will tighten quite significantly but it'll still be oversupplied. That it was oversupplied 4.3 BCF a day in the current storage cycle, and it'll be a lot less. It'll be 1.7 in the coming storage cycle, but it'd still be oversupplied. I'm sorry, this is a very sensitive computer, so I'm moving in its direction, and it's changing a step ahead of me. Given that oversupply, what's going to drive the market? And it's going to be the three factors listed there. And of those, the weather will be most important. This is just showing you graphically by looking at the last 20 years or the last 10 years, how strong the anomalies have been. This is showing you the anomalies for the season as a whole. Again, I mentioned a wild card that's extremely important here is the potential that we're going to see a real steep rig count. So those are the background factors. And what do they tell us? What they tell us is that the reality is, as we look towards this winter, that there are a fairly wide range of outcomes. And we think that, no matter who you are, especially if you're a producer making hedging decisions, or a buyer of natural gas or electricity making procurement decisions, or an equity investor investing in securities that are sensitive to commodity prices, it's absolutely critical to realize that there really are a wide range of possible outcomes just over the period of the next 4 or 5 months. And, we can, for those of you who are interested, we can take you through scenario after scenario to show you in a way that I think you find very convincing that there are a wide range of outcomes. And, even if you're a trader, I think it's very important to understand the range of outcomes, because they'll tell you a lot about whether to hold on to your positions. And so what we've done here, just to give you an indication, is that if you look at the graph in the upper right, what that's showing you is winter HDDs during the period since 2000. And you can see the wide range of variances. And what we looked at to give you a sense of what might happen are three scenarios that are indicated by the gray bars. The one in the middle is the average of the period since 2000. And then we've picked two others that we think are reasonably possible scenarios. And one fairly mild, indicated by the gray bar to the left, and the other fairly cold, indicated by the gray bar to the right. And then we've used our model, which we think can, under any given weather scenario and any given assumptions regarding natural gas, nail what the average price is going to have to be within 5 cents or so. And if you look at the base case scenario, what this tells you is that the base case scenario, if you look at the bottom of the graph, is the one in the middle. And that says that we think if we have reasonably normal weather, that essentially what the market will do is it will try to adjust prices so that we get enough coal displacement so that we get end-of-season storage of roughly 1,800 BCF. And what that would tell us, depending upon whether the market aims for storage that's slightly lower or slightly higher, is that in a normal weather scenario, if production and business as usual in terms of the rig count, then we're going to get prices that are a little higher than where the strip is right now, but not by much. That the prices will be, for natural gas, will be in the range of $2.70 to $3. And then using the same kind of analysis, if you look at the right in terms of a bullish case, we're talking about now the degree days shown by the gray bar on the right. What we think will happen is two things. One, the market will be satisfied with a somewhat lower end of March storage level. People will say, we had a big injection each of the last 2 or 3 years. So, even if we wind up with end of season storage that's between 1450 and 1650, that'll be an acceptable result, because that still is, all of you will remember, I suspect, compared to 2 winters ago, that's still hundreds of BCF higher. So we think that's one of the things that will happen. And the other thing that will happen is we think there will be a production response. And so in the cold weather scenario, we see winter prices potentially going to $3.10 to $3.40. And on the other end of the spectrum, we look at the possibility of very mild weather, and in that scenario, we expect some reductions in production, and we do see certainly if the blowtorch December scenario validates, we would expect that prices could drop to an average that's not that much higher than $2 at Henry Hub. And so, that's kind of sets the stage from our standpoint as to the results that we think could happen this winter. And, what we then try to do, the value that we hope we're adding in the flash report and our other analyses, is to look every single day to assess where we're going. And we think one should focus primarily on the 8 to 15 and 16 to 30 day windows, because we think that beyond that, the uncertainty regarding the weather outcomes is really very high. And so we focus primarily on that time frame, but we do it from the perspective of what do we think that means in terms of longer term and in terms of where prices are today and where they'll be 2 weeks down the road compared to where they could be later in the winter. That's essentially the analysis that we're doing every day. And if you tie that back to David's forecasts, what you'll see, the bottom line is that for the 16 to 30 day forecast that he presented earlier, there are really fairly stark differences. I won't flip around slides too much because I think that gets too confusing. But if you look back, and we'll be distributing the slides, at WDT's most likely the case, it is in degree days, it's only somewhat moderately colder than, I guess it's very close to normal weather. But that's in the context in which we've had very warm weather for month after month after month, and where there are a number of other forecasts who are talking about extremely mild weather later